Oh, is that right?
hmm
Well, I guess we can start and then, okay, the content is being, okay.
Hello, welcome. We are, this is our first time doing a YouTube live. So
Oh,
we're
is that
working
right?
out some of the kinks and we're excited to be with
The
you
content.
today. So today,
Okay.
Rosanna and I are coming here and we're talking about how to combine real estate and
Hello,
stocks to really
welcome. We
maximize
are,
the
this is our
benefits
first
of
time
both.
doing a YouTube live. So we're just
Rosanna, I can hear that.
and we're excited to be with you today. So today, Rosanna and I are talking. Did I cut it?
Okay. I think we're still live on YouTube, but I think because you had it pulled up and we're watching it, I could hear the sound. And so it might have been double sounding. So, hey, let's just start over. This is how it works when you're figuring out technology for the first time. So, hey,
Absolutely.
everyone. We're excited to be here with you today on our YouTube channel, Primetime Wealth Academy. This channel is for women in their 40s and 50s who are entering their prime. And Rosanna and I are really here to talk to you about investing. And so, how to really get the money things figured out so that you can go and live the second half of your life and make it the best half of your life. So, by way of introduction, I'm Camilla. I'm long-term real estate investor and business owner. I know a lot about investing in real estate. I know a lot about investing in businesses and running businesses. And I'm super excited to be here with my partner, Rosanna.
Thank you, Camilla. We're super excited to be here on this live adventure. As you can see, it's taking us a little bit of time to get used to it, but we're confident that the value they will provide will be well worth your time. So, by way of introduction, for me, I am Rosanna Quinnen, and I have been a long-term investor in the stock market. I've built my wealth in the stock market over the past 20 years. I own my own business and I've dabbled in real estate, but on a very limited scale. So that's why I'm so excited to partner with Camilla, who has experience in real estate, because we believe in diversification and owning different types of assets to set yourself up for financial success and financial security and well-being. So we'll be sharing our wisdom of how to use your money to live your best life.
Mhm.
Mhm.
And really, so one of the things that we wanted to talk about today on this live, and we're planning to do many lives like this. And so if you have a question for us and you want us to help answer some questions, please pop those down in the comment section. We would be happy to take your questions and and answer them on future lives where we're going live. But today we're specifically talking about how to combine real estate and stock investing to really maximize the benefits of both. I know you're going to hear a lot of people out there on the internet who are like super pro stock market or pro real estate. I hate the stock market. But, for Rosanna and I, although we have kind of taken different paths, we realize that there's benefit to having investments in both. And so we're going to just be chatting and kind of going back and forth about how we've built our own portfolios and some advice that we might have for you or so that you can learn from how we've built it and the different things that you can watch out for as you are looking to build your own portfolio. So we're going to kick off by starting off the first one. The first one we're going to talk about is really how to grow your assets. So Rosanna, do you want to talk about how to grow your assets in the stock market?
Yes, absolutely. So, why do we focus on assets? When we talk about money, usually the first thing that comes up to mind is income. We want to have enough income to live our lives because it's our income that helps us pay bills, helps us go on vacations, and give away money. Without that income that we can count on, it's hard to see. Hard to have that financial security, to have the confidence, and to sort of live the lifestyle that you like. So if you look at the income, generally there are two types. One is a active income that most of us earn by working, or whether it's working for somebody or working for ourselves as your paycheck or your revenue. And then we also have a passive income, which is a little bit of a misnomer because nothing really is passive. But I guess maybe what I'd like to say, maybe it's earned income versus invested income. So in order for us to earn invested income, we first need to have assets because it's typically the assets that generate income. Invested income doesn't come from just out of thin air. It's usually a return. It's usually a percentage of your money that earn on your assets. I'd like to, I have this analogy of describing your assets is like the ocean. It's just this big and powerful, and your asset base, the bigger your asset base is, the more powerful you feel and the bigger your opportunities are. And your income is like a river. It just comes in and goes. Sometimes it overflows, sometimes it trickles down to nothing depending on the conditions. But if you have this big ocean, you can survive. It will sustain your life for many years. So that's why we focus on building assets. And both an investment portfolio and a real estate portfolio are all assets that you generate on your balance sheet or the net worth statement, and we'll talk about it at some point as well. So how do you grow your assets in the stock market? You basically invest amounts of money in stocks or bonds or mutual funds, and you keep it there. You do consistently put in money in the stock market, whether it's a brokerage account or a retirement account, and your portfolio grows over time with the growth in the economy, with inflation, which actually positively, in the end, positively, in fact, affects your affects your investments. So that's in the nutshell how you grow your assets, and then we'll talk about generating income. And how about real estate? What are the types of real estate assets that we can own?
So real estate is, I think with investing in the stock market, it's really easy to start out when you don't have a lot of money, right? Because a lot of times your employer will help you with that, and they'll open up a 401k and they'll say, hey, you contribute a certain amount of your paycheck. And so you can kind of put that on autopilot. That's one of the reasons I like investing in the stock market, because it's easy to do small amounts on autopilot. And if you just get those going, you do that, right? So I'm guessing that, our listener today, you've already done that. You've already been 20 years in, putting in your 401k and and building it up and done the autopilot thing. So now when you start thinking about real estate is a little bit more intentional. You have to be a little more intentional about getting real estate, because it's not going to be $1,000 a month, right? You're going to have to come up with a bulk of money to be able to purchase the asset. Now, I like to think about real estate in, you could do it one of two ways. You could be an active real estate investor, or a passive investor. And as an active investor, that means you're the one going out, you're searching for a rental property, for example, and you're going to purchase this rental property. So you're getting the realtor, you're doing the negotiations, you're trying to find the right market, you're doing all the analysis of it, you're running the numbers to make sure it's going to be a good rental property, you're getting the loan on the property, signing on that, as the guarantor, and then also you manage the property. Now you can hire a property management company, which I always recommend, but you do that yourself. So that's being an active investor. So you're actively finding and purchasing it on your own. Being a passive investor in real estate is where you take that similar chunk of money, say it's $100,000 that you could have bought and rent a property on your own. And instead, you're going to join a group investment and join as a passive investor. And what happens there is you buy in to a larger real estate investment, such as an apartment complex, and multiple people. So there's a lot of people that will buy into this apartment complex. And then you own a small piece of a much bigger asset. So there's those two ways that you can go about doing it. For me personally, I built my portfolio by being active first and then moved into passive. But one of the reasons that I did active first was because I didn't have very much money, but I had a lot of time and I had a lot of skills that I could use to be able to go and do that. Like I was doing a lot of the maintenance myself. I was doing a lot of the landlording. I would go and I'd replace the tile myself. I learned how to tile. And so it just kind of depends on what season of life you're in. But now that I'm in the season of life where I'm in my 40s, I really don't want to do all of that extra work. I value my time more than I value money. And so my money, I would rather just put it into a passive investment and let that grow. Now, both types of assets, if you do active or passive investing, will give you very solid returns. They're backed by real estate, and so they tend to be pretty stable. But that's kind of how you grow your assets. And then, really, my advice always is to make sure you get at least one real estate investment per year. Doesn't matter what's happening in the economy. And we'll talk about market cycles here in a second. But you want to at least pick up one every year. And that's what we're doing by investing for the long term. So we're going to talk about that too. So let's switch into the market cycles. So Rosanna, talk to me about what the market cycles look like for stock market investing.
Yeah, so I guess before we go there, so we talked about sort of the asset piece, but as far as the sort of income goes, when you invest in the stock market, the income really comes from your dividends and also from the growth in your asset base that you can actually sell some of those investments and you can have income. In a real estate side, your income is your rent, right? Minus all of the expenses, so it's your net income from the property, or it's the cash flow that you gain from the passive investing that comes back to you as people pay their rent in this multifamily apartments, and then you get your share of those profits as well. Is that right?
Yep.
Yeah.
Exactly.
Yeah.
Mm-hmm.
So we just wanted to specify. So these are the types of income that you get. So now we're turning, and that's a good segue to the cycles, because you need income every year, right? It doesn't matter if the stock market is up or down, or the real estate prices are up and down. If you want to rely on that income from your investing, you need to ensure a consistent flow of income. And that's when you need to look at the market cycles and understand, okay, is this a good time to invest? And where is my investing should go towards? Is it a good time or bad time for real estate, or is it a good time or bad time for the stock market? So when we look at those market cycles, you've seen it in your job situation, you've seen it in your income. If the economy is good, the markets are up, the employment is plentiful, you have a better economy. So typically the markets will go up in those conditions. When there is a recession, when there is uncertainty, there is inflation, the market cycles the market will go down and it will kind of follow the economy. The good thing about combining real estate with the stock market is the fact that a lot of times the stock market and the real estate market will not be moving exactly in the same direction, because these two asset classes are different in their fundamentals, what they're driven by, and what is important. These two asset classes will diverge when the market cycles changes, and that's actually a fantastic thing, because knowing where it's better, quote unquote, to invest at a certain point, you can switch your dollars from one type of an investment, from one asset class to another. So there are some of the aspects or factors that affect real estate heavily is the interest rates, right? And it has very direct effect on affordability of interest rates, and whether you should be buying real estate. With the stock market, it's not as clear cut. the interest. Well, I guess when we're talking about stock market, but let's talk about capital market investing, right? Because we want to include the bond market as well, and the fixed income as well. When the interest rates rise, typically it's a good opportunity to invest if you have cash and you want to invest conservatively and you want to have more income coming to you from this interest. So the higher the interest, the higher return your money will generate. So as a passive fixed income investor, you're actually happy when the interest rates go up. So that's one of the that's a sort of one of the factors of why how the interest rates affect differently the stock market and the real estate market. So is there anything else that you can think about, Camilla, on this?
Yeah, well, one of the things to keep in mind is that when you think about inflation, which is basically things getting more expensive, right? One of those things is rent. Rent gets more expensive. Well, guess what? If you bought a property 5 years ago and then we experienced this 20% inflation, which is what has happened, your property is now much more valuable. So actually owning real estate can become what's called a hedge against inflation, meaning that if you own real estate, that the rents are going to go up with inflation and the value of your asset is not going to go down. Sometimes other assets do go down with inflation, right? And so that's one of the things to keep in mind is that's another reason to have real estate in your portfolio, because you want to have that hedge against inflation. And then, Rosanna's right. Like the stock market cycle is not correlated to the real estate cycle. So if you hear in the news that the stock market has dropped 1,000 points, right? That doesn't mean that real estate has also dropped 10% in its valuation, because real estate is much more slow moving than the stock market. The stock market is kind of like your roller coaster, and real estate is the lazy river, right? It's just going to go around and go around, and it'll go up a little bit and it'll go down to, and then it'll come back up. So real estate is a lot more slow moving type of asset. And so typically it's kind of easier to see really big changes coming in the real estate market than it is with the stock market. And so that's another reason that having both is a good idea. So as we talk about investing, really, we're all about investing for the long term. I mean, what made you your first million is probably not going to make you your next 4 or 5 million, right? So if your goal is to have at least $5 million in savings, in retirement accounts, in whatever, in order to quote unquote retire, or basically that just means not have to work anymore, make work optional, then you've got to do something different. But we also keep in mind that we're investing for the long term. So what we don't want to do is we don't want to freak out and pull out of all of our money and get into these cycles. Like we don't want to be emotional investors. We want to be very just logical and business-like with your investments and just be like, yeah, markets go up, markets go down. But as long as I'm investing every year and continuously investing, I am going to lose money, right? That's part of investing. There's risk in investing. So just keep in mind, you will lose money. But it's okay because you are investing and you're having gains elsewhere. What do you think about investing for the long term, Rosanna?
Investing for the long term is a key mindset that will definitely help you weather the short-term storms and the turbulence along the way. So if you've looked, the best thing to do is actually look at the historical trends in the markets. If you look even at S&P 500, which is sort of this list of 500 biggest companies in the United States. That index, that list of companies, their prices have gone down by more than 30% every 5 or 6 years. And that can give you like a heart attack. Oh my gosh, it's am I going to be on the street? but come see that every time the market has marched through that point and gone higher and higher over the past hundreds of years. So the long-term trends are upwards with sort of the short-term volatility along the way. And with most of us, well, when we say losing money, it's what I like to say, it's not, you're not losing money, it's that your balance is down. Unless you have sold an investment, it's what we call the paper loss. It doesn't feel good, you know. You can brag about it during a dinner conversation. Although I don't know how many women discuss their portfolios. I do, and Camilla does, but still, it's not something you can say, oh, my portfolio is down by 20%. But you can secretly say, okay, I'm just going to wait. Well, I have real estate assets, and that's when it's good to have different types of assets and look at your net worth statement and see that it may have even grown depending on how much of each of the asset classes you have invested in. So absolutely, long-term investing is the key. And it's interesting. So I watched a documentary about Warren Buffett. I hadn't seen it, and it's a fantastic story of how he became an investor and what he valued and how he viewed investing. To him, compounding is the eighth wonder of the world, and he knew that if he waited for a long time, he would have so much more money to give away. So there is a really just good, nice story about him and his wife. His wife had a really different opinion of, she wanted to give away money much earlier, and he said, just wait, I want to wait, I want the compounding to work for me, because then I will have exponentially more money to give. So that type of patience and long-term thinking is what made him successful, and it in a way can make all of us successful if we have the kind of approach, mindset, community around us support us to get us out of the funk when the markets are down. In that case, we're all big winners.
Yeah. Well, and here's another thing, like, especially for women. So, we're living longer, which is amazing, right? That's so cool. Healthcare technology has advanced, so we are able to live longer. We typically live longer than men. And so if you have a spouse right now that's a man, then chances are you're going to outlive him, right? And so you need to make sure that you're set up, because I know that none of you want to be a burden on your children. I don't want to be a burden on my children. I want to make sure that I have enough money to be able to take care of myself. And so I don't have to become that big burden. And so remember, right now we're in our 40s and 50s. We still have another possibly 50 years to live, right? And so we want to take advantage of that, and really, like, now is prime time for investing. It's not just prime time for our lives and to live our lives, but it's just prime time to make sure our investments are going towards really good places so that we can set up our portfolio. And speaking of setting up our portfolio, I loved Rosanna shared with me the other day an analogy she had for building a portfolio that had to do with a balanced meal. So Rosanna, will you share that?
Yeah. Whenever I teach and speak to investors, I'd like to come up with some comparisons that would bring it home and really help understand just maybe some unknown, unfamiliar topics. So when I was thinking about creating a portfolio and what can we compare it to, where I thought, well, it's really like putting together a meal. Really putting together a balanced, nutritious meal for your family that nourishes you, that feeds you, and also gives you the comfort, and also gives you pleasure, and it's fun to have as a family getting together at a table. You can actually think about assets and compare them to food groups. So for example, you have proteins and carbs. You can think of them as real estate and the stock market. So you want to have combine your proteins and carbs for a good meal. And then you also have your veggies like broccoli that could be compared to your cash, right? It's boring. There isn't much going on, but it's good for you. So you kind of want to have it in your portfolio. And also then you can have some dessert ice cream, which could be your cryptocurrency. Maybe not too much because it's not so good for you in good conditions, in big chunks or big amounts, but you can dabble in it and just see how it feels. And that's also a matter of preference. Some people are vegetarian, some people don't eat meat, some people will strongly believe in one thing versus another as it comes to food. And same with investing. You can sort of craft your own portfolio and your balance based on your beliefs, based on your values, right? We can talk about impact investing. You only want to invest in companies that do certain things and earn their profits from a certain type of activities. So you can combine your values, your needs, your goals, and your preferences into a holistic meal. And so you can do the same with your portfolio. You can have some real estate, stocks, bonds, cash, some alternative investments, and in one of our lives we will be talking about businesses and venture capital, which are increasingly a focus for me, and I know Camila, it is for you. But basically, nothing is inherently good or bad. Everything has a role every type of food has a role in your meal, and same time every asset class has a role to play in your portfolio. So that's the analogy that I like to share.
It's so good. It is so good because, and the last thing that we wanted to touch on was just this concept of consistency, because consistency wins. And if we even use our balanced meal, right? If you eat a balanced meal every day, that wins the health battle too, right? Because I know, how my health is changing. I'm perimenopausal. I mean, all the things, right? And so just trying to figure out the different ways our bodies react to the foods is the same thing that we have to figure out with the investing world. And the nice thing about it is that Razan and I have got your back. We're here. We are so excited to launch Primetime Wealth Academy, to have you as part of it, and to really just support you in this journey to make sure you get your finances figured out, make sure you get a good investment plan going, and to set you up for a fantastic second half of your life.
Yes, so super excited to share what we know. And in this conversation, Camila and I talk about these issues all the time, and these are so real for us, and they are real for you. Except what I find is there is a lot of opportunities to talk about these topics in a very open, honest, transparent way. But why not? We as women are a strong force. We acquire more and more wealth. So it's, in a way, it's our right, but also responsibility to really own it, and to do it right. To focus first on our well-being, but then on the well-being of others around us, whether it's our family and whether it's our community or our world. So we want both us and also you to be comfortable and happy with your progress and your wealth.
Mm-hmm. Yeah. So this is the first of many lives to come. So again, if you have questions or if you have something specific you want us to address in one of our lives, please post that in the comments below and we will definitely address it. So until next time, we will